Equity markets are in a strange place at the moment because we're seeing equity valuations almost as high as they were during the dot-com bubble, and yet at the same time we're seeing the worst economic data in living memory, with US unemployment going above 14%. So how can we square these two opposing points of view? And what would it take to trigger another equity sell-off? Now, if you want to keep abreast of what's going on in markets, but also learn more about how to invest, what better way could there be than to sign up for our free weekly market roundup? There'll be a link at the top of this page. So now let's look at that dichotomy between equity markets and the economy in a bit more detail. This is not a recommendation. If you want advice tailored to your specific circumstances, seek independent financial advice. So let's start by looking at some of the economic data. Here's a cover of the New York Times on May the 9th. At the top of the page, they've got the monthly change in jobs in the United States since the end of World War II. Red means a decrease in the number of jobs and grey means an increase. Now, during periods of recession, you can see that the number of jobs falls, it goes red. And this is the global financial crisis in 2008. In order to visualize the huge number of jobs which have just been lost, the New York Times used the whole of the front page. So the number of jobs lost starts off in the top third of the page, carries on through the middle third of the page, and at the bottom of the page we can see what 20.5 million jobs lost in April looks like in context. In terms of the impact on the unemployment rate, we've gone from the lowest unemployment for about 60 years to an incredibly high rate of 14.7% in the space of 1 month. If we look at purchasing managers' indices, which are a leading measure of gross domestic product, almost any country that you look at has had a synchronized shock, with China leading the rest of the world. And only China has recovered from that shock. But it's important to understand what that bounce back means for China. The questions for the PMI survey simply ask you whether conditions are worse, the same, or better than the previous month. So if more than half the companies surveyed think that this month is just a bit better than it was last month, that would be enough to push the survey number above 50. So this certainly doesn't mean that Chinese activity is back to normal. So it's quite possible that we may see this Chinese number fall below 50 again. But what's very unusual is to see this synchronized drop in PMI numbers all across the world. Now, purchasing managers' indices are useful because they're updated monthly, but they're considered to be soft economic data. Hard economic data like gross domestic product has finally started to become available, and in Q1 2020 we saw a sharp contraction in US economic activity. The overlap with the lockdown period was fairly short for Q1, so it's very likely that Q2 will be much worse. One of the reasons for that reduced activity was a drop in personal income, and as a consequence, real consumer spending also fell sharply. And Q1 in the UK was similarly awful. So given this awful economic data, you may be wondering why equities aren't selling off. It's always worth looking at valuations rather than just prices. This is the 12-month forward price to earnings ratio for the S&P 500. That's the price of the index today divided by the forecast 12-month earnings or profits for all the companies in the index. And currently, people are willing to pay about $20 for every dollar of profit generated by the S&P. That's more than they were willing to pay before the equity market sold off, when it reached 19 times. And even at the peak of the dot-com boom in 2000, the forward PE only reached 23 times. So this is an extremely high valuation for the S&P 500, which is all the more surprising given the economic backdrop. Fair value would be far below that, at just over 15 times forward earnings. And during the global financial crisis, the forward PE fell to about 8 times forward earnings. So why all the optimism? I think Samuel Coleridge-Taylor sums up the current state of affairs very succinctly. When he was describing the state of mind for the people who read his poetry and the somewhat fantastical plots and characters, he described it as a willing suspension of disbelief. This is the same process by which we can watch The Lord of the Rings, and for a short period of time we can believe in that world of wizards, orcs, and dragons. That willing suspension of disbelief seems to be the state of mind which the Federal Reserve has managed to create. If we look at the fear index, the VIX, it peaked at above 80% during that big equity sell-off in March. That was at the same time that the S&P was falling. And it's interesting, if we look at searches for the word unprecedented on Google, that also peaked at the same time that the S&P fell to its lowest level. But when the Fed announced that it was going to buy at least $500 billion worth of treasuries and a slew of other programs which we'll discuss in a moment, that fixed many of the liquidity problems which many markets had faced, and it almost immediately increased risk appetite. And as a consequence, volatility fell, and the S&P and markets across the world rallied. So what is it that the Fed is doing to calm markets' nerves? Well, the first thing it did, which is what it usually does, is to cut interest rates. That's what it did in 2008, and they stayed at rates very close to zero until 2016, but this time it cut them to zero almost immediately. It's also come up with a whole battery of acronyms. Each of these is a band-aid for a particular credit market. The Fed can only make loans. It expects to get this money back in the future, and it can only lend to solvent entities. Companies get short-term funding via the commercial paper market, where they issue short-term IOUs. So this facility ensures liquidity in that market. Money markets are the safest fund, and as such they form the bedrock of investment in the United States. In 2008, some of them suffered liquidity problems. So this facility ensures that that's not going to happen. In the longer dated corporate bond market, when bonds are first issued, that's called the primary market. And this facility ensures that that market will continue functioning. And that means that companies can carry on issuing corporate bonds, and that way raise funding for themselves. Once those bonds have been issued, they're often traded in the secondary market. And this is the more controversial of the schemes, because a secondary market corporate credit facility can also buy investment-grade exchange-traded funds, but also junk bond funds, high-yield ETFs. So even companies with lower credit qualities have benefited from the Fed saying that it's going to buy high-yield ETFs, and their funding costs fell sharply once the Fed announced this. In the US, things such as credit cards and student loans are packaged up inside structures called asset-backed securities, and in order to keep that market functioning, the Fed has created the term asset-backed securities loan facility. Some commercial mortgages are also funded this way. And finally, local governments in the United States partially fund themselves via municipal bonds. That's another market which started to see some liquidity problems. So the Fed's created this municipal liquidity facility to avoid that happening. This whole table is taken from the IMF Global Financial Stability report in April 2020. And this is a larger table from which that excerpt was taken. So this is what the US Federal Reserve is doing in the United States. But other central banks across the world have their own programs, such as the ECB in Europe, the Bank of Japan, the Bank of England, and the Bank of Canada. All are intended to ensure that markets continue to have liquidity, that assets continue efficiently trading, and that global markets don't just freeze up from fear. Altogether, they're maintaining this suspension of disbelief to try and get us through this crisis. But this certainly comes at a considerable cost. The top panel here shows the size of the US Federal Reserve's balance sheet. You can think of that as the sum of all of the assets which the Federal Reserve owns. Notice that the axis is in trillions of dollars. Now, when quantitative easing ended, you can see that in 2017 the Fed started to shrink its balance sheet, which had reached a level of just over 4 trillion. In the bottom panel, you can see the weekly change in the size of the Fed's balance sheet in billions of dollars. Even at the most rapid rate of increase in the first round of QE during the global financial crisis, the rate of purchases never exceeded $300 billion per week. But if we zoom in on this crisis, you can see that the size of the balance sheet has increased from 4 trillion to over 7 trillion, and during the most rapid week of purchases, the Fed was buying almost $600 billion of assets every week. So in terms of the size of the stimulus, but also the speed at which it started, the Fed has come out with all guns blazing. And if we look at rate cuts across the world, the largest economies in the world, those of the G20, are shown in the darker red color. You can see these very large cuts all across the world. as each central bank does its best to stimulate its own economy. So that was monetary policy, which is the remit of central banks. Now let's look at fiscal policy. The difference between fiscal policy and monetary policy is that the government can give grants. They can just give away money rather than lend it. And again, there's a kind of acronym soup here, with the largest of the relief programs called the CARES Act, which has cost the US taxpayer $2.3 trillion. And this probably isn't the end of it. We'll probably see more of these acts in order to soften the blow of this economic crisis. For those who have mortgages in the United States, Fannie Mae, which is one of the 3 mortgage agencies, has created this scheme whereby Fannie Mae mortgages can pause or reduce their monthly mortgage payments for a certain period of time. Ultimately, the money will have to be paid back, but this is a way of ensuring that people don't lose their homes or build up huge arrears while they're temporarily laid off or furloughed. Another mortgage agency, Freddie Mac, has a similar program. They've also halted all foreclosure actions until at least May the 17th, 2020. So the suspension of disbelief certainly seems to be working so far, but what could trigger a sell-off and pop this bubble of disbelief? I think time is the key thing here. The longer the crisis lasts, the greater the impact on revenue and income, and the greater the potential credit problems further down the line. And the credit rating agency S&P certainly does see credit problems in the future, with the US junk bond market increasing its default rate to about 10% of those low credit quality companies defaulting per year. And in Europe, they see that junk bond default rate increasing to 8% in 2020. Credit markets have sold the downside. That's how they earn their small coupons. And they have limited upside. So they tend to be more sensitive to bad news, and they tend to price it in more quickly. In contrast, equity investors have bought the upside, and they have unlimited upside. So it usually takes them a while to admit or capitulate when things look really bad. So what we may be looking at right now is a kind of Wile E. Coyote moment for the equity markets globally. But generally, when we have a recession in the United States, we see a very big pickup in the speculative-grade default rate. It happened in 1991, when it peaked above 12%. Then it happened after the dot-com bubble in 2001, and again in 2009. And the base forecast from S&P is currently that it's going to reach 10%. And their pessimistic forecast is that it'll reach as high as 13%, which is more than any of those 3 previous crises. Moody's has come out with a forecast for emerging market default rates, and they think those default rates are about to increase very significantly towards the end of 2020. They have a range of outcomes according to how bad the situation gets, but they consider it extremely unlikely that we're going to stay at the current very benign credit environment in emerging markets. Now bear in mind that when credit spreads widen, that's also extremely negative for equity markets. Another worrying development is the degree of concentration of the S&P 500 in just a few tech names. So if we take Microsoft, Apple, Amazon, Alphabet, and Facebook, altogether they constitute about 1/5 of the market capitalization of the S&P 500. We saw a similar concentration just at the peak of the dot-com bubble in 2000. One of the big supports for the US equity market in particular has been the very large level of stock buybacks. In fact, the biggest purchasers of US stocks has been companies themselves. But Goldman expects the rate of those stock buybacks to halve this year compared to 2019. Goldman's chief US equity strategist, David Kostin, says that 51 companies have suspended their share repurchases since the beginning of March. And that's already about 1/3 of the aggregate buybacks last year. So if we take away that support for the US equity market, that makes the upside for US equity look a little bit less positive. Another way that companies return money to investors is via dividends, and the UK market has been particularly generous in the past with its dividend payments. But there have been a series of announcements of UK companies cutting its dividend. And one of the largest stocks which trades on the London Stock Exchange, which is Royal Dutch Shell, decided to cut its dividend. And that's the first time it's done so since the Second World War. But it's certainly not alone, as nearly half of UK companies have cancelled or reduced their payouts. And this is another reason why equities may become less attractive in 2020. You might think that it would be less likely that the US would ratchet up the trade war given what's going on with the US economy. However, that doesn't seem to be the case. In the Phase 1 trade deal, which was announced last year, China agreed to buy $200 billion worth of additional imports from the US. But given the impact on China's economy, that's going to be increasingly difficult. So it may be that equity markets also have to contend with the negative impact of these trade tariffs between two of the largest economies in the world. So equity markets are in a very precarious position. There are lots of stumbling blocks in the road ahead. Now, if you enjoy these videos and you want to see them continue, then please support us on Patreon. For $10 a month, you get to join us on Slack. That's the chat application you can see here beside me. And then we vote on questions for the Sunday evening call. And then once the call is completed, we post the notes on Patreon along with a video replay. So you can see the backlog of previous calls. And we also post the notes so that you can follow along with all the relevant links if you want to research a topic in more detail. So there's the link. Please do support us. And as always, thank you for listening.